Hey everyone, welcome back to Corporate Decoder, the place where we dive into the world of corporate filings. Today we are cracking open Orthofix Medical's latest report. It's a bit like a medical drama, complete with strategic investments, a few unexpected twists, and a merger that sounds more complicated than a surgery. This report is like a snapshot in time. It's from February of 2025, covering the happenings leading up to that point. The big news is Orthofix Medical released its financial results for the fourth quarter and the entire year ending in December 2024. Now let's get into some financial terms. There's constant currency, which is like comparing apples to apples. It helps the company see how sales are really doing without the mess of different countries' money values changing. Then there's free cash flow, which is how much money the company has left over after paying for things like new equipment or buildings. It gives a good idea of how well the business is running and how much cash it has available. We also have adjusted gross profit, which is the profit after subtracting the cost of making the products, but with a few tweaks to give a clearer picture. And EBITDA, which is a way to look at a company's earnings before you factor in interest, taxes, depreciation, and amortization. It is kind of like looking at the raw earning power of the company. Okay, let's talk about some of these adjustments. They can include things like the cost of employee stock options, which is a non-cash expense, meaning it doesn't directly affect the company's bank account. They also adjust for the impact of foreign exchange, gains, and losses that don't really reflect how the company is performing. Then there are costs related to the merger with C-Spine, like severance pay, contract termination penalties, and fees. The company doesn't see these as part of their core operating performance. Strategic investments also get a separate look. These include due diligence and integration costs. Acquisition-related fair value adjustments can include a bunch of things, even things like gains and losses and costs associated with acquired research and development. Amortization of long-lived assets are also considered, like patents, customer relationships, and trade names. Gains and losses on investment securities also get the axe. These are usually non-cash and not part of normal operations. Then there are litigation and investigation costs. These are related to legal judgments or settlements. Medical device regulations also get adjusted, costs to comply with the European Union's rules and getting rid of products they won't sell there anymore. Succession charges are also looked at. This is regarding the transition of certain executive officers. Finally, the long-term income tax rate is adjusted. The company has an expected tax rate of 28% for 2023 and 2024. So why does Orthofix Medical use these non-GAAP measures? Well, they say it helps them see how the company is doing, compare themselves to competitors, and set goals. It gives them a clearer picture of the underlying business. The company plans to share an investor presentation. This presentation is to communicate with those who invest in the company so that they are aware of plans and news. There's also an interactive data file included with the report. It helps everyone get the data they need from the document. Okay, so what's the story here? Orthofix Medical is trying to give investors a clear view of how the company is performing and some of the interesting things that come with it. By using these non-GAAP measures, they're hoping to show the true potential of their business without getting bogged down in temporary or unusual events. But it's up to us to decide if we believe them. In my opinion, Orthofix is playing a complex game. Their focus on non-GAAP numbers suggests they want investors to see the underlying potential, but it also means you need to dig deeper to understand the real picture. The C-Spine merger is a big deal, but those merger-related costs can muddy the waters. The company appears to be in a period of transition. It's working through things like regulatory changes, investments, and those executive transitions. Whether they can successfully navigate all this while growing revenue remains to be seen. Keep an eye on how those adjusted numbers line up with the standard GAAP figures over the next few quarters. Any big differences could be a red flag. Thanks for watching, and if you enjoyed this deep dive, please like, comment, and subscribe for more Corporate Decoder videos.